So, we know from the previous lesson, identifying a trend is the objective of technical analysis. One of the methods that traders use to identify trends is to connect areas of horizontal support or resistance. Knowing the direction of the prevailing trend should feed into a trading strategy. Second, trend lines act like dynamic support and resistance. We project them into the future to identify potential areas where the price might reverse and change direction.
So what exactly is a trend line?
A trend line is a straight line that connects significant highs or significant lows. Look, if we connect the higher lows with a straight line, it becomes a bullish trend line. With these higher highs, we do the same.
Right. So can we draw trend lines to basically help us identify the direction of the trend? Would we say this example is of an bullish trend?
Yes. Do you recall we said the most recent price action was the more important?
Yes.
Well, by connecting these lows and highs, our analysis is telling us that the most recent and more significant support or resistance levels are being found at subsequently higher prices. That is a pretty good indication that the market is trending up.
And how do they help us identify potential support and resistance levels?
Well, if you project the trend lines forward, what you now have are potential areas in the future where support and resistance might form. The next time our price approaches either line, we would consider it possible support or resistance.
Okay, I see. Is it the same for a downtrend?
Yes, but you're connecting lower lows and lower highs. Look, we connected lower lows to project potential support. We connect lower highs to get our potential resistance. I need 3 touches before I can call it a confirmed trend line. Then the more touches where the trend line is tested, the stronger it is. As it develops, the more technical traders in the market will be noticing and trading it. Therefore, the more significant it gets. As before, if there is more volume traded at these points, then that's also adding to its significance.
This makes sense. It's all good in theory, but can you show us one in a real market?
Yes, let's do that now. Let's pull up a chart of the S&P 500. That's the index of the largest 500 companies in the US. So, this is a support trend line developing. We've drawn the line from the closing prices. I can see it being tested at least 6 times and confirmed. It hasn't been broken, so traders would attach quite a bit of significance to it should the price return to it.
That seems pretty straightforward. I notice you only drew in the support line. Do you need to have a resistance line connecting high highs as well?
No, not necessarily. Sometimes you get a clear set of support and resistance lines developing and you can draw in a channel. In fact, there might be one here. This is a weaker resistance trend line. It's only been challenged 3, maybe 4 times, and the price has just broken through it. In an uptrend, the important line in our analysis is the support line. This is because the bulls who are driving the trend are being really tested. They are withstanding the pressure and the trend is continuing. In a downtrend, the important line is the resistance.
Okay, what about the angle of the lines? If the trend line is steep or shallow, does that mean anything?
You are on fire today. You've actually picked up on something really important. A steep trend line suggests one party, the bulls or the bears, are in complete control. This exuberance typically doesn't last long. As traders, when we see a really steep trend, we are looking for signals that it's running out of steam. Also, too shallow and the trend might be too weak to trade. I mentioned before, and it's worth noting again, that support and resistance is self-fulfilling. We know horizontals from previous highs, lows, and round numbers can be potential areas for future support and resistance, as well as trend lines connecting these areas. If we logically roll this forward, it means anything popular that market participants use to form opinions on price can also be used by technical traders to better understand potential support and resistance. Basically, if lots of other participants are looking at something, then that is worth us analyzing it.
Yes, it's all about what market participants expect the market to do. When there's a lot of indications that the market might move in a certain direction, and if everyone is looking for it using the same techniques and tools, then it can become self-fulfilling. Participants start trading, buying, selling and setting orders based on these indicators.
Good explanation.
Okay, so what indicators help us find support and resistance?
Well, it can be any popular indicator or technique. You probably won't know what they are yet, but moving averages, Fibonacci retracements, pivot points are three technical analysis tools that are widely considered useful for helping spot support and resistance.
I can take an educated guess of what a moving average is, but the other two I really don't have a clue about.
Well, that's fair enough. I will explain each one in detail a bit later in the course, and I will be sure to go through support and resistance examples then. All you need to know at this stage is support and resistance develops at levels of psychological importance. What constitutes psychological importance can be as simple as a round number, a previous turning point, a trend line, as well as any popular tool or technique that gets the market participants trading in a collective group. As analysts, we should be looking at the popular techniques if we are to develop our edge.